What's up, guys? It's Rob here, and today we're going to be talking about some of the biggest catalysts in the market, some of the things that have been moving markets, unfortunately, to the downside for the past while, and why I think that stocks have actually gotten pretty darn cheap. All right, we're going to talk about why not only I think this, but why some other individuals are thinking the same thing, and what's going on in the market overall. So we're going to start off talking about some of the big catalysts that have been driving stocks down for the past while, and then kind of make our way into why stocks might be historically pretty cheap right now and could be looking at some significant upside over the next couple of years, all right? And keep in mind, none of this is financial advice, right? So the first thing we're going to talk about, the first big negative catalyst, you guys all know it. It's Russia and Ukraine, and you can actually see I put China in parentheses right here. Now, Russia and Ukraine has been on the forefront of people's minds for the past month and a half. A lot of people have been very worried about what's been going on there, about some of the side effects that have been developing due to the whole situation in the overall world economy, as well as some of the side effects geopolitically, right? What might China be doing in Taiwan based on what they see Russia doing in Ukraine, right? So a lot of fear has been generated around these three locations: Russia, Ukraine, China, and Taiwan. And that has actually caused over the past month for a ton of even large stocks to be down massively. Microsoft down 10%, Apple down 12%, Google down 7%, Amazon down almost 10%, Tesla down about 15%. A ton of these stocks are down massively. Pretty much some of the only things that are green are oil and gas companies, and these are green pretty massively because oil has actually gone up dramatically in price. Now, speaking of which, oil is another big fear that people have. A lot of people are worried about what's going on with the price of oil. It's gotten very expensive. And this is worrying, right? Oil is used essentially to transport everything that we use and to produce a lot of what we use, a lot of the plastics we use made with oil. And unfortunately, it's not just oil that's been affected negatively price-wise, it's natural gas as well, which is responsible for a lot of our energy. Now, the big thing to realize about oil in the US is that we're not actually getting that much from Russia, which is where a lot of the slowdowns have occurred. A lot of countries, including the US, have actually decided to stop importing Russian oil. A lot of companies have gone off on their own and individually decided to do that, and that has led to massive increases in oil costs. However, today, U.S. oil tumbles more than 8% and dips below $100 per barrel. Now, it's actually back up. It's up to 102. But you can see that over the past couple of months, oil has been on a massive run-up. Now, what's important to realize about oil and why this might not be affecting the market for too long is first to recognize that the U.S. doesn't actually get much from Russia and now gets none from Russia now that there's a ban on it. But second of all, this is an all-time chart of the price of oil starting in the 1980s. And typically, you don't see oil staying above $100 per barrel very long. Now, the reason this is because it's pretty profitable at this point for companies to be selling oil. So when oil's over $100 a barrel, a lot of companies are making a lot of money. A lot of companies want to start selling more oil, and that's actually responsible for the pumps that you end up seeing in oil stocks. Like CEI has pumped up dramatically since this whole situation arose. Now CEI has actually been moving down ever since oil prices started to subdue. But during times that oil prices are moving up, in fact, you can see over the past month, it did end up peaking out around the 8th, which is the exact same time that CEI did peak out. So if we did see oil prices moving up, we'd likely see these oil stocks moving up as well. But it's very tough for oil prices to remain above $100 for a significant period of time. There's just too much profit out there for companies to start collecting. Inevitably, companies start pumping more oil. They start drilling more. They just supply the market with enough oil so that they can make more profits and so that the market has enough supply, right? So you end up seeing oil prices tend to go down eventually, right? They can't stay at these levels for too long. Otherwise, people are going to figure out places to get oil that are a little bit more expensive than where they traditionally get it, but that's still cheaper than where the current price is, right? We've just gone through a massive explosion over the past year in oil price. In fact, if you look, oil prices started the year about a year ago $65, and now they're over 100. So oil is probably not going to be a long-term threat. I would expect oil prices to go back down sometime over the next couple of months. I don't think they'll stay elevated for all that long. Obviously, during the short term, they could go up dramatically depending on what Russia decides to do to Europe. But over the long term, I'm not too worried about oil prices messing with the economy overall, okay? Now, inflation. I will say inflation is probably the biggest threat that I'm worried about. I'm the most worried about inflation out of all of these market fears because inflation is on the rise. We've seen inflation going up month after month. It's been getting pretty scary, up to 7.9% annualized inflation. And if you look at the past 25 years, we are at record numbers. So I'm not saying that inflation isn't a threat whatsoever. Obviously, it's a pretty significant threat looking at those charts. But over the long term, you have to realize stocks will normalize to the inflation that's going on. Eventually, the inflation will likely go back down. And a lot of the pain that's supposed to be caused by inflation has actually already happened in these stocks. In fact, it's happened prematurely. In fact, you look at stocks like ARK Invest, Kathy Wood's ARK Invest, mostly growth stocks, some of which, a lot of which aren't quite profitable yet. They need to take out money to continue operating. That's not great in an inflationary environment because interest rates tend to rise. That's the next thing we're going to discuss. And you can see ARK is actually down since November. It's down about 57%. And the inflation that we're seeing, while dramatic and potentially going to increase, is not all that dramatic, right? I don't think it warrants a 57% decrease in these stocks that Kathy Wood has picked. And that's not even what it's done since the beginning of the year, since the beginning of 2021. These stocks have been higher than where they were in November. And more recently, as inflation became a more prominent threat, we actually saw these things drop pretty significantly. But I think that over the next couple of months, there is probably room for a little bit of a correction. I think this was an overcorrection from what we saw. I think these growth stocks do have some room to move. And I will say, inflation, once again, probably the most significant threat. And it is definitely something that we need to keep our eye on. But there are people working on it. Now, whether you like those people or not is a different matter, right? But the Fed is working on it. One of the tools they're going to use to combat inflation are rate hikes, which is actually something else that the market is currently worrying about. A lot of people in the market are worried about rate hikes. And this first rate hike that we're getting is actually happening this Wednesday. So in 2 days from now, you can see we got a Fed interest rate decision coming up at 2 o'clock on Wednesday. So we're going to see what the Fed has to say. Now, Jerome Powell, the president of the Fed, has already said that he expects to do a 0.25% interest rate hike. So not the most significant. And one of the reasons these rate hikes aren't likely to be as significant as what we were expecting earlier is actually thanks to Russia and Ukraine. All right, thanks to what's going on in Russia and Ukraine and the volatility being caused due to that whole situation, the Fed has decided to slow down a little bit what they were initially planning on doing, right? They were initially planning on doing a half-point rate hike, so a 0.5% rate hike. Now they're leaning more towards a 0.25% rate hike. So we're looking better than we were a couple of weeks or months ago in the rate hike department. We're not likely to see interest rates go as high due to some of the volatility that we're seeing from Russia and Ukraine. The Fed doesn't want to spook markets all that much. Now, obviously, that's not as beneficial for inflation. However, inflation is also suffering a little bit and is likely to suffer in the near future, at least from the shock to oil prices. But I will say, as oil prices are increasing dramatically, as people see this inflation going up, they're likely to naturally start to spend a little bit less. They're likely to naturally not go out as often, not take the car out as often, not drive as far, just to save money, right? Because they want to save money. They don't want to just spend more money just because prices are going up. And that tends to be a natural reason for inflation to decrease. That's the whole reason you end up seeing inflation, the laws of supply and demand. As price goes up, demand goes down. And so prices then can stabilize. So hopefully inflation isn't going to be too big of a deal, but it really might be. Now, due to all of those catalysts, we're actually looking at a situation where stocks are pretty cheap. When there's a lot of fear, stocks and whatever asset you're talking about gets pretty cheap. And right now there is a ton of fear surrounding the stock market. People are very fearful of what's going on in Russia and Ukraine. They're very fearful of oil prices. They're very fearful of inflation. They're very fearful of the Fed and rate hikes. And that has led to a ton of fear and thus very cheap prices. Now, cheap by what metric? You can look at a couple of different ones, and we're going to look at what's gone on stock price wise. But first off, you can see growth stocks have been hurt dramatically, right? Obviously, we know that over the past month, a lot of larger stocks have been hurt, but growth stocks in particular have actually been hurt pretty dramatically as well. If you take a look at this chart, this is a chart of the forward PEs for the S&P 600 small cap stocks. So smaller cap stocks have actually seen their price to earnings ratios decline quite a bit. And this reading is accurate as of March 8th. So just a couple of days ago, we have fallen pretty dramatically. And I actually marked this red line myself, where you can see stocks typically do not remain these small growth stocks, at least, do not remain at price to earnings ratios this low for significant periods of time, typically, right? In 2008 and 2009, it was a bit of a different story. There was a financial crisis going on, and stocks remained pushed down for a while. But as of late, we haven't seen over the past decade just about stocks remain at these levels for too long. Typically, they do rebound price-wise pretty significantly and pretty quickly. So I would expect to see the same. Obviously, past data can't indicate future results for sure, but based off the past, I would expect that that might happen. Not financial advice on my part, but we are looking at a situation where stocks have been hurt. A lot of small cap stocks have been hurt. Large cap stocks especially have been hurt over the past month. They've been hurt quite a bit. And overall, there's a whole bunch of fear in the market. I think it's making stocks pretty cheap. Now, small caps have been crushed, and you can actually see this, not just small caps, but growth stocks. I should actually say growth stocks have been crushed. And you can see this on this chart of Cathie Wood's ARK Invest Fund overlaid with Warren Buffett's Berkshire Hathaway Fund. And you can see exactly what's going on right here, right? The blue line is Berkshire Hathaway. And this is over the course of 2020 to January of 2022. ARK Invest went on a massive run and has been hurt dramatically. In fact, right now, I believe ARK Invest is actually even lower than Berkshire Hathaway. So right now, Warren Buffett's actually outperformed Cathie Wood over the past couple of years. Cathie Wood was, prior to this, outperforming Warren Buffett in a massive way. But growth stocks have been hurt hugely over the past about a year now. At this point, it's been going down. So growth stocks are in a situation where they were experiencing massive growth, their namesake, right? And then they ended up getting crushed as soon as we started talking about interest rates and inflation, and especially once we started talking about Russia and Ukraine and the problems that that might cause. A lot of small cap stocks ended up moving down dramatically due to the volatility. I think that overall, in this Buffett versus Wood situation, will eventually, over the long term, see ARK Invest come back in a big way, probably. I think that growth stocks tend to have better forms of leverage than the stuff that Warren Buffett's investing in. I love Warren Buffett, and we're about to look at a quote from him because he is absolutely an incredible investor. At this point, I believe he's not looking for the maximum growth over the long term. He's probably looking for a little bit more stability, trying to protect capital more so than Cathie Wood, who's on the younger side and is more focused, once again, on growth. She's a little bit more risky. So obviously, during downturns, her downside is going to be quite significant, pretty large. But during good times, when times are good and stocks are moving up, I think that her upside is going to be much greater than what you see typically in the stock market, right? So now we'll move on to a quote from Warren Buffett, right? Warren Buffett said this quote: "It applies now more to today than I have ever seen," all right? And it is, "Be fearful when others are greedy." Okay, so if stocks are moving up, if everyone is greedily buying up stocks, then maybe you should consider selling a little bit. And he continues, "And greedy only when others are fearful." So the only time he's saying that you should be greedy is when others are fearful. And guys, there has never been more fear in the market, in my opinion, all right? At least when I've been investing. Over the past about 5 years now, I have not seen this much fear in the market, except during the pandemic. The pandemic was actually a time when there was probably more fear in the market, and we did see historic drops. But since then, it's been pretty good times for a lot of stocks, right? Not all stocks, but right now there are just so many negative catalysts coming together, creating so much fear, and you can see it on the charts. ARK Invest is down dramatically. In fact, from the highs, ARK Invest is down about, down 66%. So pretty dramatic stuff. And these aren't even the smallest of the small cap companies, right? These are companies that Cathie Wood's investing in. They're relatively big names at this point. By the time that she gets around to them, they're relatively big names. And even those are down 66%. You all know, if you've watched the channel, there are stocks down a whole lot more than that. It's not a good situation for growth stocks, small cap stocks. They've all been crushed. And I think that they can come back in a big way. Now, we're going to look at some historic returns to the S&P and then finish this off with a quick lesson for everybody on compound interest, just a very brief lesson on that. But historically, you can see that it's not always green in the stock market, right? These are S&P 500 historic annual returns year by year. And you can see there are some years when it's quite red, and by quite a bit as well. In 2008, once again, the financial crisis, down 38% in the S&P. But most of the time, you end up seeing green. More years than not, you're green in the S&P, and in pretty big ways too. 28% in 2019, 16% in 2020, 26% in 2021. You see massive green a decent amount of the time. So far in 2022, we're actually down about 11.79%. Now, this isn't to say that we're going to come back instantly. I'm not saying that the S&P is all of a sudden going to shoot upwards and we're going to continue making big gains. That's entirely possible. It's not a guarantee, right? Nothing's a guarantee in the stock market. What I am saying, though, is that over the long term, you do, although you see some red, you also see a whole lot of green. You tend to have more green than red, and you tend to get around 10%, 10.5% just about on average in the S&P year by year. Now, the last thing that we're going to look at, compound interest, quick lesson, just to show you guys why I like buying the dip, why I like buying stocks in general, right? Let's say you start with $1 invested, and every month you put in 500 bucks. Not the most, not the least, right? More than some people can put in, but a lot of people can probably afford to do more than this. You put in 500 bucks over the course of 40 years, you earn 8%, right? That ends up being $1.5 million. And that sounds nice and all, but a lot of people want even more than that, right? So where it really helps out is to find stocks that you really believe in, stocks that you think are going to outperform the market. And if you can just get a little bit better, let's just say 12%, right? The S&P was getting 10.5. If you can just get a little bit better than that, if you can earn 12% instead of 8 on the same investment of $500 a month over the course of 40 years, you calculate that out. Instead of 1.5 million, you have 4.6. So really dramatic increases can occur in your portfolio if you can just barely do a little bit better than the market. And 12% isn't even some monumental number that a lot of people are hoping for, right? A lot of people want to double their money. A lot of people want to triple it. 12% is relatively doable. You don't have to do too much better than just the S&P to get that. Now, I'm not saying it's easy. I'm not saying there's a guarantee you can do that every year, but on average, if you're investing in good companies, doing your research, spending a little bit of time, more than the average investor, you can probably do a little bit better than the market. Now, none of this is financial advice. I'm not recommending that anyone do anything with their money or buy any stocks or do anything like that. I'm just letting you guys know what I think about the markets as well as what some of the catalysts are. And if you guys appreciate that, feel free to subscribe to the channel, to hit the like button down below. It certainly helps out the algorithm and whatnot. And I believe there's also a link in the description where you can see the locals channel where we actually pulled a lot of the information for this video from. So if you guys want to follow that, feel free to do it. It's free. You can choose to support it if you want. And other than that, guys, have a great day. I'll see you in the next one.